On October 24, 1929, a man in a three-piece suit stood at a ticker tape machine on Wall Street and watched his entire fortune vanish in 4 minutes. The numbers on that machine did not lie. Every digit that printed out meant another family lost everything they had built over 20 years of hard work. What made that morning so strange was that just the night before, those same men had been laughing, drinking champagne, and telling each other the market would never fall. Welcome to the Market Antiquarian, where history and finance reveal how the world really works. Subscribe to stay informed. To understand what happened on Wall Street in October 1929, you have to go back to the summer of that same year, when America felt completely unstoppable. Factories across Chicago and Detroit were running day and night, producing automobiles, radios, and refrigerators faster than workers could load them onto trucks. Department store windows in New York City glittered with new appliances and fashionable clothing that ordinary working people could suddenly afford to buy. Banks in every major American city were handing out loans at a remarkable pace, confident that the good times would continue rolling forward without any interruption. The New York Stock Exchange on Broad Street had become the center of a national obsession, drawing in farmers, teachers, and factory workers who had never owned a stock before. By the summer of 1929, an estimated 1.5 million Americans were actively trading stocks, and millions more were watching the market numbers in barbershops and hotel lobbies. Ticker tape machines clattered constantly in brokerage offices from Boston to Los Angeles, printing long ribbons of paper covered in numbers that seemed to go only upward. The Dow Jones Industrial Average had climbed from 191 points in early 1928 to a historic peak of 381 points. By September 3, 1929, nearly doubling in less than 2 years. That kind of growth made rational people believe something extraordinary was happening, that America had discovered a permanent new era of endless financial expansion. Economists, with decorated university credentials, published articles in major newspapers declaring that the United States had entered a period of lasting prosperity. Irving Fisher, one of the most respected economists in America, told reporters in October 1929 that stock prices had reached what looked like a permanently high plateau. Those words appeared in newspapers from coast to coast, and ordinary people read them over their morning coffee and felt deeply reassured that their investments were safe. But underneath that gleaming surface, something deeply dangerous had been building quietly for months inside the financial system of the United States. Brokers across Wall Street had been allowing ordinary customers to buy stocks on margin, meaning buyers paid only 10% of a stock price and borrowed the rest. A school teacher in Ohio could walk into a brokerage office with $100 and control $1,000 worth of stock through a simple margin arrangement. This system worked beautifully when prices rose, because every dollar of gain was multiplied tenfold for the margin buyer sitting in their chair watching the ticker tape. But the same system created a devastating trap, because a 10% drop in prices would completely wipe out a margin buyer, leaving them with nothing and owing more debt. By the autumn of 1929, billions of dollars in borrowed money were propping up stock prices across the New York Stock Exchange trading floor. Investment trusts had become enormously popular, pooling money from thousands of small investors and using that money to buy shares in other investment trusts. Those trusts then bought shares in even more trusts, creating layer upon layer of borrowed investments stacked on top of other borrowed investment like a tower of wet paper. The financial journalist John Kenneth Galbraith would later describe this entire arrangement as a house of cards built by people who believed it was a fortress of stone. Inside the tall trading halls of Wall Street banks, a small number of experienced financiers had begun to feel a quiet but persistent anxiety about what they were witnessing. Roger Babson, a statistician who had been warning about a market collapse since 1926, stood before a business conference on September 5th and delivered a striking prediction. Babson told the room that a crash was coming, that it would be severe, and that factories would shut down, men would be thrown out of work, and the situation would be serious. The market dropped sharply the moment Babson's remarks reached trading floors through telephone lines. A brief panic that newspapers immediately labeled the Babson break. But within days, the market recovered completely. And the men who had ignored Babson for 3 years felt vindicated as the Dow climbed back toward its record heights. What those men did not know was that foreign investors in London and Paris had already begun quietly withdrawing their money from American stocks during the early weeks of October. European banks, worried about economic weakness at home and rising interest rates in the United States, had started pulling capital out of New York at a steady, deliberate pace. The Federal Reserve had been raising interest rates throughout 1929 in an effort to cool what it saw as excessive speculation on Wall Street and protect the overall economy. Higher interest rates made it more expensive for brokers to lend money to margin buyers, and that pressure was silently tightening around the entire market like a slow closing fist. On Monday, October 21, 1929, trading volume on the New York Stock Exchange surged to 6 million shares, a number that overwhelmed the ticker tape machines in every office. Brokers across Lower Manhattan watched helplessly as the ticker tape fell behind by an hour, then 2 hours, then 3, leaving traders completely blind to current prices. A man standing on the trading floor of the New York Stock Exchange that Monday had no reliable way of knowing whether the price he was seeing was current or dangerously outdated. That information blackout created waves of panic, selling as investors tried to get out of positions they could no longer accurately see or understand in the chaotic trading environment. By the close of trading on October 21st, prices had fallen across most major stocks, and nervous brokers across the country began sending urgent margin calls to their clients. A margin call meant the broker was demanding that the investor deposit more cash immediately or face having their stock positions sold off without warning or consent. Telephone switchboards and brokerage offices from Chicago to Atlanta lit up with calls from panicked investors who had received their margin call notices in the morning mail. Some investors wired money from savings accounts to meet their margin calls, draining bank deposits that had taken years of careful monthly saving to build up and protect. Others simply did not have the cash available and watched in despair as brokers automatically sold their stock positions into a market that was already falling rapidly. Wednesday, October 23rd, brought a sharp and violent afternoon sell-off that wiped out $6.3 billion in market value in just a few hours of frantic trading activity. Men who had been millionaires on paper at noon that day found themselves holding worthless margin accounts. By the time the closing bell rang at 3 in the afternoon, that evening, senior partners at the largest banks on Wall Street held quiet emergency meetings in wood-paneled offices above the trading floors to discuss what was unfolding. Representatives from J.P. Morgan, National City Bank, and Chase National Bank gathered at 23 Wall Street late that Wednesday night in a meeting that would shape the next morning. These powerful men agreed to pool their resources and create a coordinated buying fund of $240 million. 2. Stabilize the market when it opened again on Thursday morning. The plan was built on the belief that a visible show of confidence from the most powerful banks in America would stop the panic and restore order to the trading floor. Richard Whitney, the vice president of the New York Stock Exchange, and a man known for his imposing presence and commanding voice, was chosen to carry out the rescue operation. At noon on Thursday, October 24th, Whitney walked onto the floor of the New York Stock Exchange with the calm authority of a man who believed he could stop a storm with his bare hands. He strode directly to the post where United States Steel was traded and placed a bid of $205 per share for 25,000 shares, a price well above what anyone else was offering. The entire trading floor went quiet for a moment as brokers and clerks turned to watch Whitney complete the purchase with a slow, deliberate nod of his head to the post specialist. Whitney then walked to other trading posts and placed large, confident bids on other blue-chip stocks in full view of every man standing on that enormous, crowded trading floor. The effect was immediate and dramatic. Prices began to rise. The panic selling slowed. Crowds of traders on the floor began to murmur with cautious, fragile relief. Outside the New York Stock Exchange on Broad Street, a large crowd of ordinary people had gathered on the sidewalk, staring up at the building as if waiting for an announcement. Police officers on horseback moved through the crowd to prevent any disruption, their horses stepping carefully through the mass of people pressed together on the narrow street. Newspaper reporters stood at telephone booths on Wall Street, calling their editors with breathless updates about the dramatic rescue attempt unfolding inside the exchange building. By the end of trading on Thursday, October 24th, the market had recovered enough to prevent a complete collapse, and the bankers exhaled with cautious, temporary relief. Newspapers the next morning carried headlines declaring that the worst was over, that the strong hands of American banking had stepped in and restored confidence to the market. The Wall Street Journal published a reassuring editorial Friday morning stating that the panic had been a technical correction and that the underlying economy remained fundamentally sound. Millions of American families sitting at breakfast tables across the country read those Friday morning headlines and decided not to sell their stocks. After all, trusting the official reassurance, but the bankers who had organized the rescue on Thursday knew something the newspapers were not yet reporting, which was that the selling pressure had not actually disappeared. It had only paused, like water held back by a hand pressed against a cracked dam, waiting for the moment when the pressure became too great and the barrier finally gave way. Saturday, October 26th, was a short trading day, and volumes remained heavy, with investors trying to quietly reduce their exposure before the following week began on Monday morning. Over that weekend, margin calls were delivered by telegraph and by messenger across the country, landing on doorsteps in neighborhoods from Brooklyn to Beverly Hills. Families gathered around kitchen tables on Sunday evening to calculate what they owed, staring at papers covered in numbers that no longer made any comfortable sense to them. A retired railroad worker in Pennsylvania spread his brokerage statements across his kitchen table and realized he owed more money than he had earned in the previous 5 years. A young couple in Chicago who had borrowed against their home to buy stocks sat in silence in their living room on Sunday night, unable to say the words they both already knew. Brokers who had been working 18-hour days since Monday were sleeping on cots in their offices that weekend, too exhausted and too worried to make the journey home to their families. Trading floor clerks in Lower Manhattan worked through Saturday night by electric light, trying to reconcile accounts and process the enormous backlog of transactions from the week. The streets around the New York Stock Exchange were quieter than usual that Sunday, but the silence felt less like peace and more like the held breath before a very loud sound. At the Federal Reserve Bank of New York, officials monitored reports arriving from banks across the country about the scale of margin calls outstanding and the resulting loan pressure. The numbers coming in from regional banks were alarming, showing that the wave of forced selling that would begin Monday morning would be far larger than anything seen the previous week. Investment trusts that had borrowed heavily to buy other investment trusts were now facing a compounding collapse as the value of their holdings fell below the level of their debts. Each point the market fell made the debt burden of leveraged investors heavier, which forced more selling, which pushed prices lower, which created even more forced selling in return. This brutal cycle had a mathematical inevitability to it that experienced observers recognized but could not stop, like watching a heavy object roll toward the edge of a steep slope. Men who had spent their careers on Wall Street and believed they understood markets completely found themselves staring at a situation that did not respond to any of their usual tools. The confidence that had defined Wall Street throughout the 1920s, that infectious certainty that America was different and special and immune to the old laws of finance, was cracking. Sunday newspapers carried interview after interview with economists and bankers who spoke in measured, careful language designed to prevent panic while concealing their own private fear. One prominent bank president told the New York Times that the fundamental business of the country was on a sound and prosperous basis, a statement his own records would later contradict. That Sunday evening, as families across America listened to their radios and tried to feel reassured by the voices of authority, something enormous was already in motion and could not be stopped. Sell orders had been prepared and were sitting in telegraph offices and brokerage drawers all across the United States, ready to be placed the moment the exchange opened Monday morning. Some of those orders had been written by small investors who simply could no longer afford to hold on and needed to recover whatever remained of their savings before it was too late. Other orders came from large institutions that had made the quiet decision over the weekend to exit the market completely, leaving smaller investors behind to absorb the impact of the selling. The machinery of financial catastrophe was fully assembled and waiting. And when the clock on the wall of the New York Stock Exchange reached 10 in the morning on Monday, it would begin. Every man who walked through the doors of the exchange on Monday morning would be stepping into a moment that would define not just their own lives, but the lives of an entire generation. The ticker tape machines were cleaned and loaded with fresh paper ribbon on Sunday evening, ready to record every number of what was about to become the most dramatic trading day in history. The lights inside the New York Stock Exchange burned through Sunday night as staff prepared the floor for the opening. Unaware of exactly how large the wave approaching them truly was, Monday, October 28, 1929, was about to begin. And nothing that happened on Wall Street after that morning would ever look, feel, or operate quite the same way again. The clock inside the New York Stock Exchange struck 10 on Monday morning, October 28, 1929, and the opening bell rang across a trading floor already electric with visible fear. Before the first minute of trading had passed, sell orders flooded the exchange floor in a volume that brokers later described as unlike anything they had witnessed in their entire careers. Men in dark suits pressed against the trading posts, waving papers and shouting prices into a wall of noise that rose from the floor and echoed off the high painted ceiling above. The ticker tape machines began falling behind within the first 30 minutes, unable to process the sheer number of transactions pouring through the system from across the country. Investors watching ticker tape boards in hotel lobbies across New York City saw prices that were already 30 minutes old, with no way of knowing how much further the market had fallen. A man in a brokerage office on Fifth Avenue stared at the tape running through his fingers and realized the numbers he was reading reflected a world that no longer existed outside that window. Trading volume on October 28th reached 9.25 million shares by midday, a number so large it physically overwhelmed the mechanical capacity of the exchange record-keeping systems. Blue-chip stocks that had seemed untouchable for years fell with shocking speed. United States Steel dropped 17 points in a single morning session on the exchange floor. General Electric shares collapsed by 47 points that Monday, wiping out years of paper gains for hundreds of thousands of ordinary American shareholders in a matter of hours. The bankers who had organized Thursday's rescue attempt gathered again at 23 Wall Street on Monday afternoon. But this time, the mood in that wood-paneled room was entirely different. The $240 million buying fund they had assembled the previous week had already been partially deployed and had made almost no visible difference to the direction of the market. One senior partner reportedly sat in silence at the long conference table and stared at the floor for several minutes before any man in that room found the words to begin speaking. The organized support that had briefly halted the panic on Thursday was now completely overwhelmed by the scale of selling coming in from every corner of the United States at once. By the close of trading on Monday, October 28th, the Dow Jones Industrial Average had fallen 38 points, a single-day loss of nearly 13% that set a record that stunned the nation. Approximately $14 billion in market value had been erased from the New York stock exchange in a single trading session, a figure the newspapers struggled to make meaningful to readers. Telegraph offices across Lower Manhattan worked through Monday night, sending margin call notices to investors in every state, the paper piling up on counters faster than clerks could process it. In living rooms from Maine to California, families opened those margin call telegrams and read numbers that made the room feel smaller and the walls feel closer than they had that morning. Some investors made the decision that Monday night to liquidate everything remaining in their accounts at whatever price Tuesday morning would bring, accepting the loss as final and total. Others telephoned their brokers in desperation, hoping for reassurance, and found the lines busy, or the voices on the other end, too exhausted to offer anything resembling comfort or hope. Tuesday, October 29th, 1929, began before sunrise for the men who worked the floor of the New York Stock Exchange, arriving in darkness to prepare for what they already sensed was coming. Clerks stacked fresh reels of ticker tape beside every machine on the trading floor, knowing from Monday experience that the volume ahead would be historic and completely unrelenting. When the opening bell rang at 10 in the morning on Black Tuesday, the sell orders that poured onto the floor represented a number so large it temporarily paralyzed the trading system. In the first 30 minutes of trading, over 3 million shares changed hands on the New York Stock Exchange floor, a pace that floor brokers described as a physical wall of paper and noise. Prices did not slide on Black Tuesday. They collapsed vertically, dropping so fast that buyers who had placed bids just minutes earlier found those bids were already far above the new market price. Radio Corporation of America, one of the most celebrated growth stocks of the 1920s, fell 40 points in a single morning session as sellers overwhelmed every available buyer. Montgomery Ward shares dropped from $49 to 50 cents over the course of the crash period, destroying the savings of thousands of small investors who had trusted the company future. On the trading floor itself, the noise was described by witnesses as a continuous roar, like standing inside a breaking wave with men shouting numbers into a crowd that could barely hear them. Some brokers simply could not execute sell orders fast enough, and investors who had placed orders to sell found their shares moving lower with every passing minute of delay on the floor. By noon on Black Tuesday, the ticker tape was running 68 minutes behind actual trading, meaning that every price shown in brokerage offices across America was more than an hour out of date. Men watching the tape in Chicago offices were seeing prices from late morning in New York, while the actual market in New York had already fallen significantly further below those numbers. The psychological effect of that information gap was devastating, because investors could not make rational decisions when the information they were acting on was already ancient and irrelevant. Outside the New York Stock Exchange on Broad Street, a crowd of several thousand people gathered on the sidewalk and stood in near silence. Watching the building as if waiting for a verdict, police officers formed a line along the front of the exchange building to prevent the crowd from pressing too close, their dark uniforms and horses creating a visible boundary on the street. A reporter from the Associated Press, standing in that crowd, described the faces of the people around him as wearing the expression of men watching a ship go down from a distant shoreline. Inside the exchange, there were moments of dark humor as brokers joked about what they would do with their new careers after finance. But the laughter faded quickly back into focused tension. Winston Churchill, who happened to be visiting New York that week on a speaking tour, reportedly stood near the visitors' gallery of the exchange and witnessed a portion of the collapse directly. Churchill later wrote that the faces of the brokers below him wore a look of strain that reminded him of men under fire, focused entirely on survival and completely stripped of ordinary expression. The final trading volume on Black Tuesday reached 16.4 million shares, a record that would stand on Wall Street for nearly 4 decades before the markets grew large enough to surpass it. The Dow Jones Industrial Average fell another 30 points on October 29th, bringing the 2-day total loss to almost 23% of the entire value of the American stock market in 48 hours. When the closing bell finally rang at 3 in the afternoon on Black Tuesday, the men on the trading floor stood in a kind of exhausted silence that witnesses described as a collective numbness. Ticker tape paper covered the floor of the exchange several inches deep in some areas, a physical record of the destruction that had just taken place above it during those 7 hours of trading. Cleaners who swept the floor that evening later said they had never seen so much paper in the building, as if the market itself had left behind physical evidence of everything it had just consumed. In the days that followed Black Tuesday, the full scale of the damage became clearer as banks across the country began tallying the loans they had extended to margin buyers who could not repay. Small banks in rural towns across the Midwest had invested heavily in the stock market, using their depositors' savings, and those banks now faced losses they had no way to absorb or survive. Within 3 years of the 1929 crash, more than 9,000 banks across the United States would fail, taking with them the life savings of millions of ordinary American families who had done nothing wrong. A farmer in Iowa who had kept his money in a local bank never touched a stock in his life, and worked his land carefully for 20 years, woke up one morning to find his bank had permanently closed. His money, which he had deposited in good faith, was simply gone, absorbed into the losses of a system he had never fully understood and had only peripherally participated in during his lifetime. This was the hidden cruelty of the 1929 collapse, that its destruction did not stop at the borders of Wall Street, but traveled outward along every financial connection to reach ordinary lives everywhere. Factories that had been running at full capacity in the summer of 1929 began laying off workers by late autumn as consumer spending collapsed and orders for new goods dried up across the country. The unemployment rate in the United States, which had stood at roughly 3% in 1929, would climb to 25% by 1933, representing millions of men and women without work or income. Bread lines formed outside church halls and soup kitchens in cities across the country, stretching around city blocks in Chicago, Detroit, and New York through the long winters of the early 30s. Men who had worn 3-piece suits to their brokerage offices in September 1929 stood in those lines wearing the same coats, now frayed, holding tin cups in hands that had once signed stock certificates. The Hooverville shantytowns that appeared on the edges of major American cities became visible monuments to the distance between the promises of the 1920s and the reality of the 1930s. President Herbert Hoover, who had taken office in March 1929 and declared that America was nearer to the final triumph over poverty than ever before in history, now faced an entirely different nation. Hoover stood before cameras and microphones in the White House and urged Americans to remain confident. But the images of empty factories and long bread lines told a story his words could not override. Congress launched investigations into Wall Street practices in the years following the crash, and the hearings revealed a financial culture built on practices that had been legal but deeply reckless in nature. Investigators found that major banks had been selling their customers stocks they privately believed were overvalued, while their own executives quietly sold those same stocks before recommending them publicly. The Senate Banking Committee hearings, led by attorney Ferdinand Pecora, exposed the interior workings of Wall Street to public view in a way that permanently altered the relationship between finance and government. Witnesses were called from the highest levels of American banking, and their testimony revealed a world of insider arrangements, hidden conflicts, and borrowed money stacked upon more borrowed money. The public watched those hearings through newspaper coverage and radio broadcasts, and the anger that built across American living rooms over those months became the political energy behind major reform. The Glass-Steagall Act of 1933 forced commercial banks and investment banks to separate their operations completely, preventing banks from gambling with the deposits of ordinary account holders again. The Securities Exchange Act of 1934 created the Securities and Exchange Commission, establishing for the first time a federal body with legal authority to regulate trading on the American stock market. These laws were written in direct response to the specific practices that had made the 1929 crash possible, creating guardrails around a system that had previously operated almost entirely without oversight. The men who wrote those laws understood that the crash had not been an accident or an act of nature, but the predictable result of allowing unlimited borrowing to fuel unlimited speculation without restraint. John Maynard Keynes, the British economist whose ideas would reshape global economic policy in the decades after the crash, argued that markets left entirely to themselves would always eventually overshoot reality. Keynes sat in his Cambridge study and wrote that the market could remain irrational far longer than any individual investor could remain financially solvent. A sentence that carried enormous and lasting truth. The 1920s had proven that point with extraordinary completeness, demonstrating that mass optimism backed by borrowed money could drive asset prices far beyond any connection to underlying value. The men who had stood on the floor of the New York Stock Exchange in September 1929, confident that prosperity would continue forever, had not been foolish people, or dishonest people in most cases. They had simply been human, susceptible to the oldest and most powerful force in financial history, which is the collective belief that this time the old rules no longer apply to the current situation. Every generation encounters a moment when prices rise so far and so fast that experienced observers begin to feel that something permanent and unprecedented has truly changed in the structure of markets. And in almost every such moment across recorded financial history, from the Dutch tulip bubble of 1637 to the South Sea bubble of 1720, that belief has eventually met the same hard correction. What made 1929 uniquely devastating was the scale of ordinary participation. The fact that millions of Americans who had never previously engaged with financial markets had been drawn deeply into the system. The margin loan mechanism had acted like an amplifier, taking the natural optimism of a prosperous decade and magnifying it into something far larger and far more fragile than the underlying economy could support. When that amplified optimism collapsed, the correction was not merely proportional to the original enthusiasm, but far larger, because the debt that had funded the enthusiasm now had to be repaid from falling assets. The lesson embedded in those events is not that markets are evil or that prosperity is dangerous, but that the distance between the price of something and its actual value is always a temporary gap. Eventually, that gap closes, and the speed and violence of the closure is usually proportional to the size of the gap that accumulated during the years when everyone believed it would never need to close at all. The physical streets of Lower Manhattan look different today than they did in October 1929, but the building at 23 Wall Street still stands, its stone facade unchanged by the century that has passed around it. The New York Stock Exchange building on Broad Street still opens its doors each morning to the sound of a bell, and men and women still stand on that floor, watching numbers move across electronic screens. The ticker tape machines that fell behind by 68 minutes on Black Tuesday have been replaced by systems that process millions of transactions per second, without any visible delay or mechanical limitation. But the human beings watching those screens carry the same hopes and the same fears that the men on the floor of the exchange carried in October 1929, because that part of the system has not been upgraded. The records of the 1929 crash survive in archives and libraries across the United States, in bound volumes of newspaper, microfilm, and in the testimony transcripts from the Pecora Commission hearings. Reading those records today means sitting with the words of men who did not know what was coming, who believed on the morning of October 28th that things would recover the way they always had before. There is something deeply human in that belief, the conviction that the world you have built and lived inside will continue to operate by the same rules it has always operated by without fundamental change. And there is something equally human in the shock of discovering that systems built on assumptions rather than foundations can change their nature very quickly when the assumptions stop holding true. The families who lost their savings in 1929 rebuilt their lives over the following decade through effort that the historical record only partially captures, because most of that rebuilding happened quietly and privately. Their children grew up with a different relationship to financial institutions than their parents had carried. More cautious, more skeptical, less likely to trust the confident voices coming from bank buildings and brokerage offices. That caution was not weakness or ignorance, but wisdom purchased at an extremely high price by a generation that had watched the gap between promise and reality close with catastrophic speed on a Tuesday morning in October. The 1920s roared. The 30s followed with a silence that was not peaceful but stunned. The silence of a country recalibrating its understanding of what was real and what had only appeared to be real. History does not repeat itself with perfect precision, but it does carry patterns forward through time in forms that are recognizable to anyone willing to study what came before with honest and careful attention. The past still has stories to tell. Subscribe and let us uncover them together.